The PE ratio helps you to see at a glance how cheap or how expensive a company is. Lower PE ratio means cheaper and higher PE ratio means more expensive. However, there's a gotcha when it comes to the PE ratio that I'm going to explain in just a minute, because just looking for stocks with the lowest PE ratio possible is not going to be the best thing for you. PE ratio is short for price to earnings ratio, and it compares the price of a stock to its earnings. The PE ratio is calculated by taking the price per share and dividing it by the earnings per share. And when we talk about the earnings per share, you need to know that this number is annualized. So when you see that earnings per share figure, that number represents earnings over the past 12 months. So let's do an example so that I can show you. We can see here that McDonald's has a price per share of $211.73 right now on the day that I'm filming this. And we can also see that the earnings per share over the past 12 months is $6.31. So if we take the $211.73 price and divide it by the $6.31 earnings, we get a PE ratio of 33.5. And obviously that's in line with the figure here shown on Google. But what does that mean and why is that useful? Here's why. Let's say company A has a price per share of $10 and an earnings per share of $1. Then the PE ratio is equal to 10 divided by 1 equals a PE ratio of 10. If company B's price per share is also $10, but it earns twice as much money, so it has an earnings per share of $2, well then the PE ratio is equal to 10 divided by 2 equals a PE ratio of 5. If you choose to buy shares of company B, then for every $10 you spend, you're gaining $2 of earnings. Whereas with company A, you're only gaining $1 of earnings for every $10 spent. So as far as this very simple example goes, company B is the better investment because it's cheaper. So a lower PE ratio is better because it means you're getting more earnings for what you've spent. Now, as I said before, there's a bit more to it that goes into it than just looking at the PE ratio, and we'll get to that soon. Here's the PE ratio again from another perspective, and there's a hidden lesson in here, so see if you can catch it. Let's imagine that there is a bakery business in your hometown that's up for sale, and you're thinking of buying it. You find out that over the past 12 months, that business has sold $500,000 worth of baked goods. So that's the total revenue. And then you find out that the cost of goods sold, like the ingredients and the packaging, was $200,000. So you have the $500,000 revenue minus the $200,000 cost of goods sold gives you $300,000 of gross profits. And then you further learn that the expenses of the business are $36,000 of rent, $12,000 worth of equipment leasing, $180,000 of employee wages, and $6,000 of marketing and advertising. So when you subtract all of those operating expenses from the gross profit of $300,000, you calculate that the pre-tax profit for the bakery is $66,000. Then, after $16,000 of taxes paid to the government, the bakery is left with $50,000 of net income. $50,000 of net income is a very important number because this is the money that you could actually put into your pocket if you own this company. Super important, right? Because who cares what the company's top line revenue is? It's the net income that's important. That's the money that the owner can either pocket or reinvest to make even more money in the next year. So always remember that net income is how much money is left over after all the expenses and taxes have been paid. Generating a net income is the whole purpose of a business. Another name for net income is earnings. Okay, that's an important point for this lesson. Earnings and net income are one and the same thing. And it's also referred to sometimes as net profit. So if somebody were to ask you the question, is this company profitable? They're asking about whether the company produces any net income. Net income is everything. So when we talk about the price to earnings ratio, now you know where the earnings part of the equation comes from. It's the net income. Okay, so let's think about this bakery business again for just a minute. And I have a question for you. What do you think it's worth? What would you be willing to pay for this bakery business? We know that the annual earnings are $50,000 per year. And for this example, let's also say that there's a very good manager in place who takes care of everything, so the business does not require any of your time. The employees look after everything. And for the sake of this example, let's just say that there's also very little risk as well. So you're pretty much guaranteed that $50,000 of earnings per year. So what would you be willing to buy this business for? Try to come up with your own answer. Maybe even pause this video for a second and think about it. Remember, $50,000 per year without any effort on your part. Think about it. Okay, so if the current owner were selling this business for $1 million, that would mean a PE ratio of 20. $1 million price divided by $50,000 of earnings equals a PE ratio of 20. If the current owner were selling this business for $500,000, that would mean a PE ratio of 10. $500,000 price divided by $50,000 of earnings equals a PE of 10. If the current owner were selling this business for $250,000, that would mean a PE ratio of 5. $250,000 price divided by $50,000 of earnings equals a PE ratio of 5. Notice how a lower PE means you're buying the company's earnings for a cheaper price. By paying a lower price, you will also be getting a better annual return on your investment. In other words, your ROI would be better when you buy it cheaper. If you paid $250,000 for this business, your annual return on investment would be 20%. Because $50,000 is 20% of $250,000. If you paid the $500,000 price tag, you would end up getting a 10% annual return on your investment. And if you paid the $1 million price tag, you would end up getting a 5% annual return on your investment. And yet another way of looking at it would be that if you paid $250,000, your investment would pay for itself after 5 years of earning $50,000 per year. If you paid $500,000, your investment would pay for itself after 10 years, and if you paid $1 million, your investment would pay for itself after 20 years. The hidden lesson here is that the PE ratio works the same whether you're looking at it from the perspective of the entire company, like this bakery example, or from the perspective of owning just a percentage of the company through shares of stock. All that a share of stock is, after all, is just a piece of the company's ownership. Okay, now let's bring it back to stocks, and we'll look at Coca-Cola stock. At the time of me recording this, Coca-Cola has a PE ratio of 24. And we can see that the price per share is $51.04, and we can also see that the earnings per share is $2.12. So again, we take the price per share and divide it by the earnings per share, and that's how we get the PE ratio of 24. Earlier, we looked at McDonald's, and we found that it had a PE ratio of 33.5, meaning that for every $33.50 worth of stock that you purchased, you would get $1 of earnings. And now we've just seen that Coca-Cola has a PE ratio of 24, meaning that for every $24 worth of stock that you buy, you will get $1 of earnings. So does that mean that Coca-Cola is the better investment right now compared to McDonald's, since it has the lower PE ratio? Maybe. But here comes the bonus lesson that most videos about the PE ratio are not going to tell you. Let's say two example companies, Company A and Company B, both earn $1 per share. To buy shares of Company A, it'll cost you $20 per share, and to buy shares of Company B, it will cost you just $10 per share. In other words, Company A is selling for 20 times its earnings, while Company B is selling for just 10 times its earnings. Right? A PE ratio of 20 versus a PE ratio of 10. At first glance, it might look like Company B is the better investment because it's cheaper, right? It has the lower PE ratio after all. But wait, we're gonna add one more component into the mix. Earnings per share growth rate. Company A is growing its earnings per share at 10% every year, but Company B is only growing its earnings per share at 5% every year. So now when we look forward 10 years, the numbers start to show a very different story. So 10 years later, Company B, which has been growing its earnings per share at 5% per year, now earns $1.55 per share. If it's still trading for 10 times its earnings, a PE ratio of 10, then Company B's price per share would be sitting at $15.50 after those 10 years. Company A, 10 years later, after growing its earnings per share by 10% every year, now earns $2.36 per share. If Company A is still trading for 20 times its earnings, a PE ratio of 20, then its price per share would be sitting at $47.20 after those 10 years. So as it turned out, Company A would have been the better investment even though it had the higher PE ratio. The next thing for you to do right now is go ahead and check out this next video for you right here so that you can keep learning, and who knows, maybe one day you're gonna be the next Warren Buffett. I'll see you over there.